welcome to the Monday edition of Dividend Cafe. I am sitting here in our beautiful conference room atop 6th Avenue in New York City, and I am going to be running down the elevator the second I am done recording, as I have a flight to catch out of JFK tonight back to California, where I'll be a couple days, and then in our beautiful Phoenix office for a few days. So big week ahead, but in the meantime, of course, today's Dividend Cafe matters. I'm just going to hit the highlights, though, real quickly because of time. It was a interesting day in the markets because a lot of people who may have been noticing last night during the Super Bowl, if they were getting all kinds of pop-ups and warnings and noteworthy interventions that President Trump was implementing steel and aluminum tariffs across the board, and was making an announcement he was going to make about a plan to blah 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 on steel and aluminum tariffs. And then the futures were up quite a bit. And I would say part of it is, markets are not responding anymore to the threats of tariffs, or threats, or tweets about threats, about promises, about announcements about tariffs. But also part of it is that this is more targeted and more sector specific. And in fact, the steel and aluminum sector was up today, the U.S., domestic. And so there was some market response in that sense. But I think that, as I talked about in the Friday Dividend Cafe, there just isn't a real way for markets to absorb non-news. And that's what a lot of this stuff is it's not news until it becomes news. So that was something worth noting today. Because I don't want to forget, it's probably my favorite thing to be able to cover today. I could put this just in the public policy announcements, but I have like 8 other things there. So allow me just to say that one of the great things that's happened over the last couple of days, made more official this morning, was the nomination of my dear friend Jason Trennert, the CEO and founder of Strategas Research. I don't think we've done a Dividend Cafe in 10 years that didn't have a chart from Strategas Research. There has not been a day in 10 years, more or less 7 days a week, that I have not read well over 10 pages, some days 100 pages of research from Strategas Research. And Jason Trennert has been nominated by President Trump to be the Assistant Secretary for the Treasury for financial markets. Jason is also connected with Treasury Secretary Scott Bessent, and so it is not a surprise that he'd be in that group to be nominated. I can think of very few people who deserve it more. He's served as an admirable chief investment strategist and economic strategist at Strategas. I have no doubt he'll end up back at Strategas after serving in the administration. But Jason is a real patriot, a real lover of markets, a real philosophical minded economist, which is the only kind of economist I pay any attention to. And I couldn't be happier for Jason and his family for this very well-deserved honor. He will serve our country with distinction, I assure you. Okay, so the Dow was up 167 points today, a little less than half a percentage point. The S&P and NASDAQ were each up more than that, pretty much across the board, an up day in markets. We're 60% of the way through earnings season now, and growth is trending year over year, meaning the Q4 results of 2024 announced in Q1 of 25 versus Q4 results of 23 announced in Q1 of 24. You follow me? So year over year, 15% earnings growth, a tiny bit less than that, and 5% revenue growth, a tiny bit less than that. 9 out of 11 S&P 500 sectors have come in above expectations this quarter. It's been a pretty good earnings quarter so far. We still have 40% to go, but so far, so good. However, full year earnings expectations, because again, earnings results are backward looking. They're resulting the quarter that just was. Then they provide forward guidance, updating on expectations for the future. And that has come down a little bit. So full year 2025 earnings guidance is right now coming in at $271 a share in the S&P. That would mean about 11% earnings growth on the year. And we started the year expecting about 13% earnings growth, maybe a little more. But there's lots of time to go. That'll be revised further as we go. The bond yield closed at 4.5%, 10-year, up just 1 basis point on the day. Energy was the top performing sector, up over 2%. Financials were the worst performing, down about 79 basis points. And about 50% right now, right in the middle of the S&P, is trading above its 50-day moving average. So you really talk about a market kind of running in place. That's where we are. The breadth, the momentum, it's just all kind of in a range and moving up and down. And people go, is that good or is it bad? And the answer is, it's just what it is. And people trying to get a short-term prognostication out of that are not doing something I recommend. Okay. Oh, news of the day. You may have heard the Philadelphia Eagles won the Super Bowl, blah, blah, blah. Congratulations. So the House is looking to present one budget reconciliation bill to extend the 2017 Trump tax cuts permanently and address the border, energy, defense things they have on the table. The Senate wants a two-bill approach, doing the easy stuff first and then getting to taxes second, which would definitely mean much later. President Trump's priorities for the tax bill include no tax on tips, overtime. He's still saying Social Security. I think one out of those three makes it to the final, maybe 2 out of 3, not 3 out of 3. He does also say he wants to expand the state and local tax deduction, which I think he will, but how much remains to be seen. There's a lot going on with the trade and tariff talk right now, but Secretary Bahnsen really throwing down a gauntlet last week that he wants to use current policy as their baseline in setting the budget reconciliation. Gives you an idea of how aggressive the administration wants to be on tax agenda. The current policy framework is a big deal relative to assuming all the tax cuts go away and then setting it, because if they do that, it takes about $4 trillion off the table over the next 10 years. They may end up meeting in the middle at 50%, which is $2 trillion. But Secretary Bahnsen says no, he wants to go a current policy, which would basically not give them any handcuff around the tax cuts going away. I don't know if they'll be able to get that across the finish line with the House, but that's where things are. If you're lost on the details there, feel free to reach out for more clarity. But I just want to say it's a big deal, because where they set that baseline at is going to tell you how much window they have for the additional tax reform they want to do. By the way, the CBO revisions already reflect $1.9 trillion in increased tax revenue for the next 10 years. This was a big theme of mine in the 2025 year, that the deficit would be coming lower, even apart from any fiscal discipline or fiscal spending corrections. And they're still calling on $820 billion of increased spending over the next 10 years, and there's no new spending bills. So where's the $820 billion coming from? The automatic escalations in Medicaid. So if they are right, and this is the way it's going to be scored, that $800 billion in new spending, but $1.9 trillion or more revenue, then they see $1.1 trillion coming out of the deficit the next 10 years. 60,000 federal workers so far have opted into the offer to leave their job, get paid for 8 months, and leave federal government work. Consumer Financial Protection Bureau has basically been left for dead. Congress created it, so only Congress can kill it. But now, by essentially allowing it to they've marginalized it to a point of irrelevance by stopping enforcement. They've moved the new OMB director, Russ Vought, into the kind of director role on an interim basis, softening these regulations. CFPB has been taken to the woodshed. And then you may have heard President Trump said he's ordering the Treasury Department to stop minting pennies. Okay, economically, 143,000 jobs created in January. No, excuse, yeah, January, which was a little less than expected, but 100,000 jobs from the November-December report were revised upward. People always talk about revisions and always assume they're revised downward later, but it's not true. The revisions cut both ways. And we're at 92% chance a no Fed rate cut in March. That'll soon be 100. Only a 72% chance of no change in May, but 72 is still pretty high. You get to June, and we're 50-50 as to whether or not there'll be a cut or still a continued pause in rates. I'm going to leave it there. There's some information on the Fed balance sheet and the reverse repo facility. Wonky stuff that's important to understand about liquidity in the financial system. Um, so read that in dividendcafe.com. But based on my timing here, I need to let you go. Great question as to whether or not the Bahnsen Group uses options to hedge market risk in the Ask TBG section. Check that out at dividendcafe.com as well. I'll leave it there. We'll be back with you all week as always. Thanks for listening. Thanks for watching. Thank you for reading the Dividend Cafe.